if you guys can give a wave, I know your name's already under, but just in case, we have Blair Silverberg, CEO of Hum Capital, Benjamin Wu, CEO of Brex Asset Management, and finally, but not least, Miguel Larrea, CEO of Capchase. Thank you all for being here. So the private markets have changed substantially in the past couple of years, especially even in the pandemic. Traditionally, startups have used venture funding, equity funding to launch their careers, but now increasingly we're seeing venture debt and other ways of getting your company off the ground. So we're here to discuss effectively the different kinds of fundings, the pros and the cons, and where we're headed next, and effectively the evolution of the venture capital market as an entire whole. I'd love for our panelists to introduce themselves and really talk about where you guys stand in the broader ecosystem so our viewers can get a good chance to really see where you guys are coming from. I'd also like to remind our viewers that you guys can submit questions and we will get to them either at the end or throughout this panel. So to just jumpstart everything, I'd love to start this off with Blair, if you'll just give us an introduction about your company and how you're looking at the market currently.
Sure. So I'm Blair Silverberg. I'm the founder and CEO of Hum Capital. I founded Hum after being a venture capitalist in San Francisco at Draper Fisher Jurgensen for 5 years. And you can think of us as Kayak for private capital. So there's about 6,000 airlines in the world. You navigate them by going to Kayak. There's about 13,000 institutional investors and commercial banks. And similarly, you can navigate those by coming to Hum and then going on a financing process after that.
Right. So effectively, you are not particularly focused on either debt or equity. You kind of are across the board, everything. So I'd love to progress over to Benjamin over at Brex. Please do tell us a little more. You guys are a pretty new shop, actually. So do tell us a little bit more about how you work.
Yeah, sure. So Brex Asset Management was started last year. We are the capital arm and investment arm of Brex. If folks don't know Brex, it's a scaled fintech company. Now we have over 40,000 customers. They're customers across venture-backed technology companies, e-commerce companies, small and medium-sized enterprises, but a very large segment of venture-backed tech companies are on our platform. And the asset management arm, we started in our building. All right, she's very excited about my introduction. But we're building in order to provide capital solutions to that base of customers. Our first strategy is the venture debt strategy. We're providing debt plus warrants capital to a variety of high growth companies, typically Series A, Series B type stage, and have had strong traction so far. My background before this, I've split my career between more credit, direct lending, special opportunities. I was at Fortress and Macquarie, and also tech growth equity was at General Catalyst. So excited to be here today to speak with you and talk about these exciting topics.
Fantastic. And do tell us about you, Miguel. You focus on a very specific sector of the tech industry when we're talking in terms of venture debt and also non-dilutive capital financing. So please do tell us a little bit more about your approach and why you're focused on this segment of the industry.
Of course. Thank you. It's great to be here. So yeah, what we're doing at Capsticks is we are automating everything that touches a dollar for software businesses, right? So that goes from financing, revenue management, expense management, treasury, and FinOps. We have started with financing because it was the most expensive pain to solve for customers. And I mean, we're all going to talk about that right now. So yeah, we have primarily 2 products in the market. One that helps software businesses to bring forward their future revenues so they can reinvest them into growth without having to tap into the cash reserves or VC money. And then another one, which is kind of like the mirror image, where they can push out large expenses into the future and pay those in installments, right? So the result is that they have more cash upfront to redeploy into growth. So we started over the summer of July 2020. We were actually doing our MBA at Harvard and we dropped out to just focus on this. And since then, we've made available over $1.5 billion to thousands of businesses, both in North America and in Europe and in the UK. And the result is that they've added thousands of months of runway to the businesses and delayed or avoided altogether funding rounds, and they just grow much faster without tapping into the cash.
Yeah, that's really fascinating. Why, going back to that, why do companies grow faster? Why have you seen companies grow faster by raising effectively this kind of financing versus equity?
Yeah, so primarily what they get is predictability over what's going to happen into the future. And then, based on how the revenues are growing, that unlocks additional financing. So they can almost turn into like a growth flywheel where they bring forward, the ARR. Let's say a company with $1 million ARR, they bring forward $300,000. They reinvest those into growth, and they turn those $300,000 of cash into another, let's say, $400,000 of ARR, and they do it again and again and again and again. And then that means that they just grow super fast without tapping into a VC money, right? Because the ARR just keeps growing, and they keep doing the same cycle. And we've seen cases of companies growing from 70K to 7 million ARR in 6 months. Others going from 200K to 30 million ARR in a year and a half, right? So it really is transformational.
Right. And I see you guys nodding along as well. Ben, did you have something to add to that?
Yeah, I was going to say that, a company's path in its growth is not very frequently and almost always not linear. And, I think equity fundraising rounds tend to look for certain markers to be able to kind of meet a certain threshold for Series A, Series B, Series C. And I think what these alternative forms of financing offer is that flexibility to extend runway, to invest in growth, invest in R&D, invest in sales, to be able to kind of reach that next marker with less dilution. And so I think we try hard here to craft these flexible structures and capital where these companies can access that capital and continue to grow, but be able to kind of meet that next marker for that next round to achieve the valuation that these companies are looking to do with really, a better valuation for less dilution then, but also, for us to kind of give them capital with less dilution. So you kind of benefit on both ends is kind of how we look at it.
Right. And I'm curious, I think that this is coming, we're having this topic and this conversation about raising later rounds, around the flywheel, around constantly increasing revenue at a really interesting time. We've just come off of an incredibly hot bull market, and we're not really entirely off of it quite yet, but there's definitely conversations within venture capital that some of the equity financing is starting to be a little slow. Maybe some of the rounds are being renegotiated by some of the bigger players within the cross asset spaces. And so I am curious, and I'll throw this question at you, Blair, which is effectively, when this all slows down, what happens to debt financing? Does debt financing play a bigger role? Do debt financiers have to effectively be more creative with the way that they're underwriting because we're not sure where the revenues are going from now on? I'll leave the answer effectively to you.
Yeah, I think so. Normal companies consume equity and debt, both, right? So in the S&P 500, about a third of the capital base comes from debt. 2/3 of the capital base comes from equity. In the Bessemer Index, an index of the world's most valuable private companies, mostly SaaS companies, Salesforce is in this index, Square is in this index, only 2% of the capital structure comes from debt. So I think the first thing people need to understand is there's a huge difference between how normal companies historically finance themselves and how venture-backed companies, a relatively immature financing industry, will evolve over time to look more like a normal industry from a debt and equity perspective. So that's the first big thing. In the 80s, there was the emergence of this thing called the high yield bond market, made famous by Michael Milken. And essentially what happened is you had companies, including companies started by T. Boone Pickens, Carl Icahn, some of the most famous financiers of the modern era, Henry Kravitz at KKR. You had companies that were unable to finance themselves because there was no debt available to them. And they were going around to family offices and basically passing the hat. And so the high yield market completely changed that. So I think that the first way to answer your question is there's just going to be a massive shift of debt entering into the mix and changing the mix to look a little bit more traditional, the same way that an S&P company does. And then I think the second thing is there's a macro cycle that we all go through. And so, we can talk about this at length, but basically we've gone through a period of extremely low interest rates, ballooning asset prices. And what that does for companies is it makes equity very cheap. That's reversing with S&P down 10 to 15% in the last couple of basically a month and a half. And so when that reverses, that either means lower valuations if you're raising equity, which you have to stomach and put as a permanent part of your track record, or it means looking for alternatives. And so we're seeing more and more companies look for debt. And debt is a complicated space, as you guys have heard from two of our panelists. There's a lot of options out there. They're very different. They're incredibly accretive to companies over equity in many cases, but you have to navigate them and figure them out. And that's basically what we help companies do.
Right. I think this brings up a really interesting point, which is effectively a lot of these models are relatively new. You guys are very tech focused. You're very data focused. And that is one of the big add-ons, pluses effectively of debt. So I'm curious, when you're looking at going forward, you are going to get more volume, it sounds like, as equity becomes more expensive. How are you thinking about underwriting? Do you anticipate that changing in the next year or so? So I'll throw that at Miguel first.
Yeah. So yeah, I think well, the volume is definitely increasing for a number of factors, and to build on top of Blair's point, companies are still growing really fast, right? But the equity, that the valuations are cooling down. That means that equity is becoming more expensive. So you think about it, like why we're seeing this additional demand into debt as well is because companies are seeing that the delta, the difference between paying for equity and paying for debt is becoming larger than ever, right? So people also traditionally thought about equity as being 0% cost of capital, right? Like you raised $20 million, you don't have to pay any interest, you're not paying anything. You think about it, equity is actually extremely expensive. On average, venture capital returns 30% to the investors, right? But the best companies return 100% year over year or 1,000% year over year. So that's actually a cost of capital. So if you compare 100% versus 10% or 6%, then the delta is massive. So that's why companies are also starting to understand that, hey, money is green. Yeah, this is going to cost me a little bit of interest, but it's going to add as much growth as equity. So how we're seeing in terms of underwriting also, is that we just need to be very conscious that, hey, if equity money or if VC money cools down so much that companies that would have gotten funded last year will not get funded this year, then we just need to be able to distinguish, hey, what is the threshold, and what are the individual unit economics and metrics of each business, understanding what is the impact of them getting money that they actually have to return, right? So to what degree can a company convert money into growth and return that money, right? Because that is when companies, and us, frankly, could get in trouble if we're just, giving money that doesn't get converted into growth and can be returned in an efficient way.
Yeah, I would add, I think that's really interesting and correct. And I think two thoughts. I think one, in terms of the advent of debt and other structured solutions to this market, I think in some ways it's really just educating folks. I think a lot of companies, when they think of equity, it's pretty straightforward. It's valuation. There's probably a lot less structural considerations. When it comes to debt, there are things like term, the interest rate, covenants, borrowing base, and convertible preferred, liquidation preferences, and et cetera. There's a lot more to think about, but I think it's one of those things where as companies get used to these different terms and see all the benefits that we're talking about, it becomes much more, I think over time, going to be much more open to folks and companies being willing to kind of access these pools of capital. So I think that's one trend that I think is happening. And second of all, I do think that the availability of this capital to different venture-backed tech companies is not even. I feel like in this market, the haves will be even more haves and the have-nots will be even more have-nots. I think cash is king. And I think that for companies that have ample availability to capital, have certain business models like SaaS software, there's going to be a lot of availability of debt capital. And that's also because the lenders are looking at these sort of companies and thinking, this is safe. This is, I can underwrite this, and there's a lot of metrics. And I do think that other business models over time are going to mature as well, and there'll be more availability of capital to those companies as they tend to show the metrics that that everyone's looking for when looking for more of a structured solution.
I think I just want to add one thing to this, which is the metrics are such a critical part of unlocking debt financing, because the difference between the haves and the have-nots generally comes down to companies that can explain their traction clearly, so that investors say, oh man, this thing is really working. Those companies have a massive cost of capital advantage. And everybody else, you may have a great business. Even like I always use the example of Sarah Blakely, the founder of Spanx. I mean, she toiled away for years in her basement building Spanx, and she would take them to farmers markets and sell them to people. And if you looked at her data, like they were selling like crazy, but she had an access to capital problem. So I think it's really important that you can use your data well to tell your story. And there's a variety of things we can dig into there. I think that this is something that's really important to us when we look at companies. We should, with all of the availability of SaaS systems of record, essentially every company, 75% of companies are running on systems that spit out a bunch of data exhaust just by virtue of using them to run your business. Every company should be able to close that education gap. And if it can close the cost of capital gap, which makes the economy more fair, more transparent, democratizes, frankly, the delta between the haves and the have-nots. And so I think this is an incredibly important piece of the puzzle.
I think that's a great point.
Yeah. So we're all in the venture capital space in some way, shape, or form. So let's take the rocket ship view of this, which is right now we're talking about underwriting effectively what sounds like the first stage of what you're looking at in terms of creating this more holistic market where there's debt and there's equity. And the focus right now is on SaaS companies with recurring revenue. Blair, you're talking basically, I appreciate that you brought up the Spanx example because we're now talking about companies that don't clearly have a very easy access into, we don't easily have access into basically what recurring revenue looks like. They're more seasonal. Let's look 2010, even years later. Are we expecting maybe more options for financing for companies like, and this is not a great example, but a Casper or a Peloton at the moment, financing methods that are perhaps geared towards these companies and maybe help them get through really tough times?
I think one thing I just want to mention really quick is this is a little perverse, but a company like Casper or Spanx has the ability to compound capital at a much, much higher rate. So a high quality Casper properly financed can grow much faster than a SaaS company. However, to your point, there's seasonality. So if these businesses classically, when you're selling in Q4, there's a holiday push to buy. And so long story short, there are fundamental differences between a business that has, let's say they're selling a physical product or a physical product with a little bit of subscription like a Peloton versus a SaaS business that might be a very stable set of cash flows. And so there's different financial methodologies that you need to understand these different businesses. But usually, kind of the term in economics, there's no free lunch. Usually there's trade-offs. So if you're getting that great stable SaaS revenue stream, that is awesome, except for it's very long duration. So you're taking what's called duration risk. You may not get paid back on your investment in that company for 18 months or 2 years, much like a life insurance company or a insurance brokerage that has a subscription business, a telco. There's a bunch of businesses that have subscription cash flows and they end up being pretty long duration businesses. Conversely, in a consumer product business, you may buy an ad and get paid back in 14 days. And so that business has the ability to turn capital at an incredibly profitable rate. It could fundamentally be a better business, but has a very different characteristic of cash flow streams. And these are exactly the kinds of questions you need to understand about your data to be able to close that gap to investors and convince them, hey, yeah, I'm not in a 60 of the category. I'm selling a widget, but gosh, my widget is like 7 times economically more efficient than that beautiful widget software that you're looking at otherwise. And really, that's the burden of the entrepreneur when raising capital to make that case.
And I think on that point, it's a really interesting point because you talk about an e-commerce business versus a B2B SaaS business, and the B2B SaaS business obviously has that recurring revenue, and as a result has that availability of debt capital for it because it can be underwritten. You can see a long-term cash flow stream, and lenders feel comfortable with that and can structure around that. E-commerce is one, as Blair mentioned, it's got more ups and downs. You got consumer, if it's not even subscription, it's got a lot of consumer risk. It's got seasonality risk. And so typically there's been a lot more availability, I think, of equity capital for that than debt capital. And so that's something that we think about. I do think that when taking a data approach, it's what comes to the conclusion that equity makes a lot of sense for B2C e-commerce, but we're thinking about, is there a way we can structure a non-dilutive type instrument to really kind of assist e-commerce entrepreneurs to grow. But fundamentally, the data, even B2C subscriptions, is a very different retention curve than B2B SaaS. And so we're trying to figure out how best to approach that because they've got different risks and opportunities, to Blair's point, and how best to kind of structure an investment around that so it makes sense for all parties.
And you have a ton of data on how these businesses operate, probably from the card business. And so you're sort of in this amazing position to invent a financing product that delivers non-dilutive capital where others might not have the data or be able to mine and figure it out.
Well, I'm curious in that case, how you guys view a company like Thrasio or Perch, or basically any of the e-commerce roll-ups that are financing their roll-ups via debt. So it's a little different from what you're talking about because I'm assuming that the e-commerce businesses that the two of you are discussing aren't necessarily in our scenarios buying another business, but I am curious how you guys are viewing that trend at the moment.
Those companies are really interesting. There's a lot of capital being directed towards that sector, and that, I would say, the reason why that's debt financed is a little different ways, because the B2B SaaS, you're underwriting the revenue and the recurring stream. A lot of these companies are actually cash flow positive. So, an aggregator is buying them for 2 to 3 times EBITDA, or less or more, depending on the company. And then as they aggregate, they're able to value themselves at very significant EBITDA multiples. And so when you're lending against it, you're actually at a pretty conservative cash flow multiple. And so those companies can be viewed at, I think, with a lens of a multiple of cash flow, which is very rarely what you see in the venture debt market.
Right, but effectively, that's more private equity than venture debt.
It's got some of that flavor, yeah.
Yeah.
Yeah, it comes back to, I think, businesses that are profitable can inherently pay back debt at some level, and businesses that are not profitable, you have to make the assessment: will they one day be able to pay back the debt at some level? So there's a fundamental distinction. It's not to say that a profitable company always gets better financing terms. In fact, that's kind of the point of the Bessemer index analogy. If you're trading at 40 times revenue and you've got a manufacturer in the S&P 500 trading at 2 times revenue, who's getting the better financing terms, even though one might be profitable and one's not profitable. But yeah, to Ben's point, there's a fundamental distinction in terms of how a lender looks at those businesses.
Right. So I'm sorry, Ben, did you want to go?
I'll just add one last thing. And to your question as to how things may evolve, I do think that now there's a lot of lenders who are looking purely at the cash flow, and so are comfortable lending, say, 5 times, 6 times off of EBITDA. And in the world of venture-backed lending, it's very different. So one may see actually within there's a lot of efficiency within the positive cash flow market more, I think. So from a LTV perspective, it's a lot higher percentage as a percentage of the value of the overall business, because there's a lot more lenders comfortable with it now. Over time, there may be that gap may be closed, where the LTV may be higher for some of these venture-backed loan products.
Right. So, I mean, Miguel, you focus basically exclusively on SaaS companies. Do you ever see a future in which your company begins to open up to effectively like an Allbirds or an e-commerce business without those recurring streams?
I don't think so. So, and the reason why is because you're trying to do a very horizontal product to be able to underwrite a ton of different business models. You either have to have one specific model for each business model, one underwriting model for each business model, or you need to revert to very few common indicators of what makes a company safe, right? So then if you're trying to underwrite, imagine like a lumber company and a restaurant and a SaaS company and an e-commerce company, there's nothing pretty much in common except top line growth, cash flows, EBITDA, and so on, right? So which means that in a bull market, everything works and you can lend to anybody and you get your money back because everything is going up and to the right. But when things go sideways, then your model doesn't understand anything of what's going on or the nuances of each vertical, and then losses spike. And that happened with pretty much any SMB lender 5 years ago, right? So what we're thinking about is there are multiple ways of growing a business. You can grow, one product for everybody, and a lot of software businesses are like that. Very few lending businesses are like that, right? Or you can make a vertical product, and go very deep and create multiple products that complement each other for one single vertical. That's why we are building, that's why we're automating everything that touches a dollar, but only for software businesses. Because, if you understand revenues really well and you build revenue software, and you understand expenses really well, and you build expense software and treasury and FinOps, then lending becomes extremely, extremely safe because you have the best data, in the market, and then it just makes things easier.
Right. Effectively, so what I'm hearing kind of as a collation of everything that's happening, and I'm hearing right now, is that yes, there may be more models in the future, some kind of debt model that will handle more of these e-commerce businesses, but at least individually from your perspective, because you're verticalized already, there's not a lot of synergy for you to take on that additional line.
Totally.
Yeah. So I'm curious, I mean, we've talked a lot about debt, we've talked about non-dilution, the benefits of it. I would love to play basically devil's advocate and go into the question of what is the benefit of holding equity as well. And so let's ask Blair, who is the kayak of the industry.
So I think the most simplistic way to think about equity is when you take out equity from an investor, there's no obligation to pay it back. So just fundamentally, if you're funding an R&D project and you think it's going to cost $10 million and you have no idea, you may get to the end of that $10 million and not have a business. And so you want to raise another $10 million to try project number two. Equity is a really good solution for that, because at the end of the, like, let's say 2 years or 4 years, you don't have to pay that back to anyone. That's the most simplistic way to think about equity. So it's always the lowest risk. But of course, as we know from economics, the things that are the lowest risk end up being the highest cost. So you're making trade-offs. And I think the wrinkle that is really important to understand, though, is that while it's true that you don't have to pay equity back to people, in venture land, there's a liquidation preference on equity. So whenever you raise equity from a venture capitalist, you're paying typically a senior 1x multiple to that VC. So let's say you raise your $10 million, you do your R&D project, and then you say, gosh, I'm going to go sell the company for $10 million because I built something really valuable, but there's no business here. How much money does an entrepreneur get? Most people would be like, I don't know, I sold 20% of my company, I probably get $8 million and the investors get 2, but that is not the right answer. The investor gets all $10 million and you get $0 because of the liquidation preference. So most of the equity we think of in venture land is actually kind of debt-like. In like the public markets, it would be called structured equity for that reason. And there's a spectrum between pure pro rata, proportional, kind of common equity, which is how people think of equity, and a super senior, hyper structured, revolving line of credit. And so there's all sorts of things in the middle. And companies that have the most advantageous cost of capital end up blending a variety of them. And that's why you'll never see the S&P is like 100% debt finance. That just doesn't happen. You'll never see another business other than, ventures pretty close being 100% equity finance, but that's not sustainable long term. So it's always a blend of the two.
Right.
Yeah. I think that equity, to Blair's point, it is necessary to start something from scratch, right? Because at the beginning, if you don't have revenues, like nobody can underwrite you. It's really hard to underwrite a team taking an asymmetric bet, and expecting to get the money back, through just non-dilutive financing. So equity, I think, is just necessary, and I think that 10 years from now, equity will still exist. It will probably be more concentrated earlier stage, right? And then for things like geographical expansion or new product lines where you're constantly taking asymmetric bets, you don't really care if you don't have to return the money if the bet doesn't work out. But that you're using expensive money for things that could generate 1,000x, 10,000x returns in a few years. On the other hand, everything that's predictable, and a company has hit product market fits and has sufficient cohorts of users, and has proven that they can put money to work and generate more money either through cash flows or through enterprise value, then anything that's predictable should use non-dilutive capital, and the cheaper the better, obviously. And if you think about it, why I think that VC money will be more concentrated in earlier stage is because I compare launching a company and taking it all the way to exit, similar to taking a road trip across the US, right? So if you are taking a road trip and you are raising VC money in every single round, it's similar to stopping the car every time you need gas, and then drilling a well, taking the petrol out, refining it, and then putting back in the car and keep going. And then you do it again and again. Whereas non-dilutive capital, if it's scalable and it's metric driven, it's almost like going in the car, and the more miles you drive, the more fuel you have, right? And you don't really have to stop. You can just keep going. So that's why at the beginning, in earlier stage, you can raise capital and you should raise VC money. But then as you start stacking up revenues that are predictable, that importance of VC money, of equity money, should naturally decrease.
Yes. So actually, let me throw in a question. I see you're about to talk, Ben, and maybe this question from the viewer might actually inform a little bit of where you're going. So this viewer says, kind of along those lines, Miguel, you've kind of answered, I think, a little of the question, but they sound like they have had some traction with their company. They are bootstrapped, but they have never had venture capital funding. They say, I've built a bootstrap company that's doing 10 million plus in ARR, grew 2 times year over year. It felt hard to raise debt alternative financing because we are not venture backed. it seems venture money is an indicator that helps de-risk and helps underwrite the business. And that does seem to be true, at least within the SVB model. And so I'm curious, how does this group view non-venture backed businesses and companies and are there tips to approaching capital raises for a profitable business?
Yeah, well, let me just chip my 2 cents in. I think that, a lot of companies only lend to VC-backed companies for 2 reasons. One, they're deferring the responsibility of underwriting to a VC, that has done it before. And 2, they think that if the company isn't able to, continue growing, there's a backstop in the sense that the VC will put more money to work to keep the company from dying. We work with a ton of bootstrapped companies. In fact, I admire them a lot. So yeah, please, we would love to help this listener. And yeah, the only difference between bootstrap companies and VC money is that, and VC-backed companies is that, when you hit on a big market and you start growing like that and you become successful, that puts a target on your back. So, raising VC money early on can help you to capture the whole market, and instead of leaving it open for competitors. Whereas bootstrapping, you kind of have to grow, slower and be extremely, extremely diligent about cash management. But yeah, we work with anybody.
I think one really important just line of thinking for this particular company is different lenders think about different things. So if you have ARR, it's like true SaaS ARR, next month is going to be the same or higher as last month. You'll be able to get between 1 and 3 times ARR in terms of leverage. So if it's a $10 million business, you could potentially get a $30 million check. And that's going to come from a range of maybe 25 to 30 private credit funds. There are also businesses that are very, very deep, SaaS specialists, exactly like Miguel's describing. And there's a handful of other options, but think of that as like ARR leverage. And it's going to be, cost of capital generally is going to be like at the lowest possible in very high single digits, but all the way up to potentially the 20% range. There will probably be warrants. If you also have EBITDA, so let's say you're on $10 million of ARR, you are a $1 million EBITDA business. Commercial banks will give you, call it 2 to 4 turns of EBITDA, so $2 to $4 million at like 4 or 5%. And there's often no warrants. So there's just a lot of questions you have to answer, basically, like, hey, which one of those is better now? It kind of depends on your growth trajectory. If you're going to grow a lot, be pretty insensitive to the cost of capital because you can grow your ARR tremendously. You can reach an inflection point. You may even be able to go public. If you're not going to grow a lot, then bank financing is critical because it's going to have a very, very low cost of capital. You'll be able to basically pay yourself a dividend. So there's all sorts of questions like normal businesses ask. That's why Goldman Sachs is out there helping every business that's raising more than $150 million figure this kind of stuff out. But in private market land, it's pretty difficult.
Yeah, I was going to add that I think debt and equity work really together as in partnership. As Miguel had mentioned, earlier stage companies naturally are at that point of the curve and risk curve where equity really makes always makes the most sense. But as companies grow and there's various times where there's more risk, equity continues to make sense. I do think that to the point that lenders are all very different and take very different approaches. Some, I think, take the approach of really just backing the quality of the venture base, and it's really kind of focused 95% on that. And as long as there is that availability of capital and there's amortization across the amount of capital invested, then that's something that's really attractive. I do think that in some instances, it almost matters less as to what's the enterprise value in the backing when the quality of the revenue stream is very strong. Then it's not really about the venture backer, but really about looking at and analyzing and factoring the revenue stream. So I think that there's a broad range in terms of how folks look at things. I think for us and others, it's kind of a combination. Both are important, but at the end of the day, it's often looking at what are the different factors that make this a good investment. And I think just every single party has a different way of looking at it in its own lens.
Right. So effectively, not only is it about kind of not being equity, it's also about looking at it from a different model. You're not going to be evaluating things, or you're trying to not evaluate things on the same terms that equity markets would. So another, I guess, a way of asking this question is you're looking, so we had a viewer who asked about something we talked about a little bit earlier about venture capital money smashing records last year. Equity was very cheap. you guys have basically seen going forward that it's going to become more expensive because the markets are turning. But it is also true that interest rates have been rising as well. And so that's going to change things. That's going to change how expensive debt is. And so, how do you balance that, right? How do you balance the rising interest rates with the fact that the equity markets are still relatively hot at the moment?
I think in the range of different data points that one has to look at, whether it be the investor base, from the investor base to kind of evaluating the company. I think in this market, it's hard to really just purely underwrite the investor base and say, no matter what, that capital will be there from the equity point of view. I think it's more and more important for any lender because, the lender only gets relatively capped upside. We get warrants and et cetera, but relatively capped upside. So it's very important not to kind of back opportunities where you're going to lose a bunch of money. It's very different for equity investors that can have tremendous upside in one investment. And so I think it's going to put the onus more on lenders to be able to really dig into the company, understand the company, believe in the management, believe in the TAM, believe in the opportunity, as opposed to purely backing the investor base. And then separately, I think it's important to continue to be very close to one's portfolio companies because you can't always rely on that company being able to raise capital. So it just requires, I think there's a lot more companies that are looking for debt capital in a shakier market. And it just requires being a lot more thoughtful on deployment and also thinking about one's portfolio companies.
I think it's also really important though to think through where is the capital that you are borrowing or getting access to coming from, because there are life insurance companies, for example. We work with a handful of them that have fundamentally fixed rate cost of capital. So like they're in the business of selling annuities. So they say to retiree, hey, you're 65, you want a 5% payout for the next, call it 30 years. I'm going to give you that at a fixed 5%. Doesn't matter what happens to interest rates. So that's a stakeholder who doesn't have floating rate capital. And so interest rates go up, they're at a tremendous cost of capital advantage because they've got all of this capital that they already took from the underlying policyholder at a fixed rate, and they can in turn make that available to you. And so they're kind of living in this world that's totally different than banks, private credit funds, and anybody who thinks about a floating rate exposure. And so this is just one kind of data point on the variety and the heterogeneity in the global capital marketplace. This is the beautiful thing about capitalism in the marketplace we have is you've got literally 13,000 institutional investors and commercial banks who are thinking about like, what's my edge? Where does my cost of capital come from? What can I do in this environment that other people can't do in this environment? So it's really important as a potential borrower or recipient of an investment to ask the capital provider that you're working with, like, just kind of walk me through, like, this is a totally kosher question to ask. Like, just walk me through kind of where your capital comes from. If you're a bank, I assume it's deposits, yes. If you're a life insurance company, like, is it fixed or floating rate of capital that you have? I mean, these are totally fair questions to ask. This is going to be a major partner in your business. The way their capital works is going to impact how the capital is made available or not available to you. And in an environment where interest rates are changing or the market has some volatility, it's totally appropriate to ask these kinds of questions.
I think that also, yeah. So both are great points. I also think that the price should not only be determined by the sticker price, by like, hey, you're gonna pay 5% interest rate over the SOFR or whatever, right? I think the way the capital is deployed can actually really affect the price that's paid, right? For example, one thing is to get, let's say a term loan for 5 years, interest only, let's say at 10% cost of capital, where you end up paying, let's say 50% in total of the capital deployed. And another one is, imagine if you could just inject the right amount of money into user acquisition, and then you only actually paid the day that you're capturing that user, right? So then you're in reality paying only for a very short amount of time until that user has generated enough revenues to pay back the loan, and then you're not paying anything else, right? So the timing and the amount and the use of funds can actually determine a lot how much you end up paying for that financing. And also, as long as the return on investment of what you're using the money for is higher than the cost of funds, that theoretically is an infinite movement machine, right? You could do that forever and make money at a very, very efficient cost.
Yeah, this is such an important point. And this is like, for example, a place like Capsticks is innovating, but it's exactly right. It's the all-in cost of capital, your time, how much of you have to have sitting in your bank account unused, which you're paying interest on. It's the all-in cost of capital that is so important.
Basically, a lot more calculating, it sounds like. So I'm also, Miguel, we've talked a lot about kind of from a more top-down level what this all means for investors, for the founders as well, to kind of basically combine equity with debt going forward. You actually do have this model. You've raised both equity and debt for your company. And so I'd love to walk a little through your thinking on that. What was the logic there?
Yeah, absolutely. So basically the logic, and I'm going to go back to a point earlier, is that if we were to give money to Capsticks customers, at let's say between 5 to 10% cost of capital, but our equity costs between 500 to 1,000% per year, that doesn't make sense. Like, we would be losing money, hand over fist, right? So where can we find capital that is cheaper than the return we make, right? So at the same time, we want to make the cheapest cost of capital available to our customers, right? So what we decided was, okay, we're going to use equity money for doing things that are not predictable, for engineering, for new products, for entering new markets, for potentially, acquiring other smaller players and things like that. And then we're going to use credit facilities from massive, credit funds, asset managers, banks, eventually even like public markets through securitization, to access the lowest cost of capital that allows us to transfer all those savings to our customers, and then, build our own flywheel, which for us is have the cheapest cost of capital in the market, work with the best customers. They perform the best in the best way. That allows us to prove to the capital markets that our assets are really safe. So the cost gets lower, so we can work with better customers, and it just keeps accelerating.
And I think that's a really interesting point. And I think Capsticks is kind of a specialty finance model. And the specialty finance model actually really is a fantastic model for understanding the cost of capital necessary, because at the end of the day, it's lending out capital at a very specific return, and looking at that versus the cost of capital one's able to achieve. And it's a perfect example as to, an early stage especially finance company has to equity fund because it doesn't have the access to a larger warehouse line. And so how to think about getting a venture debt line or some more efficient cost of capital, so isn't losing a lot of money while it scales to a $20 million book, at which time a warehouse lender may be willing to start to take some risk, thinking that itself will grow, so that the warehouse lender will be doing a $100 million facility. So it's a really perfect example as to building the track record and size and scope necessary to attract more efficient pools of capital, and especially for these earlier stage specialty finance companies, not having that availability and having to equity finance very expensively in order to get to that scale. And it's very clear as to what's the cost capital and also what's the exact return when lending out that each dollar.
Right. So effectively, there's some projects, some developments that require or should be better cost benefit wise for debt, some that are probably better for equity fundraisers. It is interesting because there are cases where in debt, right, that you as a lender may put on certain restrictions on a company so that you kind of safeguard that your company is safe. And so if you are a company, right, and you're trying to, the equity might look more attractive to you in that case because you have more power. Maybe you made an agreement with the existing lender, or sorry, not the lender, the equity, the venture capital firm behind it. And so kind of how do you, if you're a founder, decide what to take, or decide that in that case, lending is more attractive?
I mean, we help companies with this, but I think it's always worth figuring it out. Like, it is always worth actually understanding what the debt term sheets you're getting look like, and like what they actually mean, what all the terms mean, what the economic conditions mean, et cetera, because that will be the cheapest cost of funding. And the lower your cost of capital relative to your competitors, the more advantage you have against them. You can pay more for customers, you can sell your product at a lower price. So I mean, this is like the core of kind of economic theory and competitive advantage. The cost of capital really matters. So like, it is worth it to figure it out. If you're a company in the audience, like, you want to figure this out. You don't want to be like, oh gosh, debt just seems complicated. I'm going to go with equity, because I always joke, like, as a CEO, I mean, I routinely make stress over decisions that are 1,000 times less important than how I finance my business. But when it comes to financing the business, just economically, like when it comes to financing the business, it's like, oh gosh, I'm just going to go with the tried and true, even when, by the way, like the tried and true in like, venture universe, not the global economy. So I just think it's really important to figure out the actual answer to these kinds of questions.
I will also add that. Oh, sorry, Ben. Go ahead.
No, please.
Oh, I was just going to add that, there are many types of VC money or venture money. Some you're just getting money, right? So others you're getting money, advice, partnerships, business development, and everything, right? So I would say, hey, like if you're going to get venture money, which as we agree that it's necessary, at least the earlier stage, then make sure that you're getting much more than just money. Because if you're just getting money, then it's going to be very, very expensive. But I mean, I couldn't be happier that we decided to raise venture capital, of course, and also from the parties that we actually went with.
And I was going to say that I was agreeing that it makes sense to be very fluent across the range of options that one has. I think there's a lot of different flavors of debt. There's different flavors of convertible preferred, and traditionally speaking, if one is very bullish about one's company, it makes sense to think about debt, because you're going to be able to continue to outperform and raise more. But if you're a little nervous about, could this thing actually struggle, my company struggle, then debt may be something that can have real downsides too. But there's a lot of different flavors. To Blair's point, a lot of the investment capital on the equity side does come with a one-time lick pref, and that has debt-like features to it too, but doesn't have a term. And so I think it makes sense that there's a lot of nuances in it to make sure to be fluent and understand the kind of range of different outcomes and the different nuances to a specific deal.
No, it's kind of funny. I feel like one of the crux underlying questions or themes that we're hearing right now is do your homework. The challenge is that for a lot of founders, the venture capital space is huge, it's broad, it's lacking transparency. You're not necessarily seeing who's necessarily within a fund is a good investor and who isn't, who has a good reputation, who doesn't. And so do you, and of course, I think this is a very salient question for Blair in particular, but do you guys see, and also, well, actually Benjamin too, but when you guys are looking at kind of funding and trying to decide between, equity and debt, obviously who the players are, who's backing them, what the terms are, all matter. Do you ever see a kind of, and we've tried this before several times with venture capital, but do you ever see kind of a rating system, a venture capital / debt equity rating system that increases transparency, but is maybe a little bit uncomfortable, one day actually becomes valid?
You're talking about rating for the capital providers?
Yes, I am talking about rating for the capital providers.
It's interesting.
Like an eBay rating.
Good idea.
Yep.
You can start that company.
It's yes, like that will exist. I think it's legitimately tricky though. So I think first, like you have to be in a position where you see a lot of financing that's getting done. And I think like all three of us are in that position. So I suspect like if you ask Miguel or if you ask Ben or if you ask us, like, our opinion on your VC, like we're going to have an opinion because we've seen other companies transact with that person before, and companies that had a term sheet and went with someone else and whether or not they were happy. So I think like, really the market today is informally solving this problem. Now, like systematically solving this problem with eBay style ratings, I think will become really important too with time. But you have to be really careful because sometimes investors, I'm just thinking about some of my equity investors, in Hum, it's like, they were really nice to write a check without a lot of, diligence, time spent in the first year. And then I didn't hear from them for a couple of years. And then they came out of the woodwork to do some insanely valuable thing for me 3 years later. So like you want that rating system to be accurate and not biased. But I think with time, somebody will create something like that.
And I do think there is sort of a quote unquote risk premium for, just like on the other side, when you're looking at a company, if you're a company looking to raise capital, there's a quote unquote risk premium for a less known party who's kind of new to the business. Obviously some parties have been around for decades and decades, are going to get like a reduced risk premium because how they'll act. They've been around for a long time. They've acted always supportive to companies. And so I think it's important for any company speaking with parties, like looking to find a most supportive partner in every way up and down the cap stack. And I do think that there tends to be, for a company that has a lot of different access, getting the best terms, getting the best investors, getting the best lenders is just more of the, the haves are getting that access to that capital. So I do think for any party, it's important to be constructive. It's important to be a partner to the companies. As long as the economy keeps doing well, it really is important over time to be a party that people want to work with. Otherwise, I do think it's going to be a relatively short shelf life, unless it's really kind of trying to choose the companies that really have no access to capital otherwise.
Yeah. So I am curious, do you see this basically being codified in that case in some way, right? Do you think that the inherent transparency, the lack of transparency effectively on the side of the capital's providers is actually just a natural part of how this market is going to work going forward? Like that should stay versus a more, a rating system?
You mean the business model for your new company? You mean? I'm just
kidding. For my new company.
From my standpoint, I actually do think that there is actually some real efficiency if one starts to, as a capital provider, starting to act in ways that are not constructive. I do think it gets out in the market pretty quickly. It's a small world, and I think people know a lot of folks, so it's important to be constructive and a good partner. But the rating system, still a good business model.
It's like anything else, though, right? It's like we rate hotels on hotels.com. We rate every product you could possibly buy, and Amazon has a rating. So eventually there will be ratings. I think it's just really important that you're, like I was saying before, that the rating is accurate, because the worst kinds of rating systems are if they introduce bias. It's like that new amazing venture capitalist that's super thoughtful, knows the space incredibly well, but has never done a pro rata, right? Like their pro rata follow-on rate is 0%. That means that, if you put them in a rating system, it's like, should you take money from this person? Well, historically, they've never invested in subsequent rounds of, companies. Like that would ding them, but that's not appropriate. So it's a hard problem to get right. But I think that we've gotten it right in pretty much every other sector of the economy. So I think it's only a matter of time that this will happen in capital allocation too.
Okay. Well, looks like I'm going to have a lot of money in another 10 years. So let's go back to the questions. Can you, and this is more broad, this is from the viewers, can you talk about the onboarding process for companies looking for financing on your respective platforms and how it differs from that of traditional lenders?
Yeah, sure. I'm happy to start. So traditional lenders involve like a lot of paper pushing. So you need to prepare a ton of data in Excel, in PDF, send it over, get it back, get comments, do it again, do a couple presentations. So it is very, very similar to VC. And the thing is that I would say it's even harder, right? Because I think Ben mentioned it earlier, like debt providers, if everything goes well, they make 1.0 something %, right? If everything goes bad, they lose everything, right? Whereas in VC, if everything goes bad, you lose everything. But if everything goes well, you make 1,000x or 10,000x or, astronomous returns. So then lenders are really careful about protecting the downside. So, traditional lenders are like that, very people-driven, paper-driven, etc. I think that the new players, it is much more API-driven and data-driven. So instead of preparing documents, you just sync your systems, and then we extract the data. That data gets processed, gets given back to the company that's applying for financing, and then that's when they get a result, almost in hours as opposed to weeks or months. At least that's how it is in Capsticks. So yeah, happy to send it over to Ben.
Yeah, so that's great, and I think certainly more efficient than traditional ways of doing things. But at Brex, we leverage the platform a lot, and so most of our companies that we're backing are existing Brex customers. So there's a lot of familiarity both ways with the companies with Brex and with Brex with the companies. Both. So I think there's trust, there's data, there's accessibility, and generally already a strong dialogue. And so we leverage that relationship and the data on the platform to onboard companies, provide them solutions. So we know these companies. We're obviously, I think, post term sheet learning more about the companies because we're looking to provide them much more capital than they have prior, and also looking to support these businesses going forward. But there's a lot of leveraging of existing data and relationships to craft a solution that I think really helps these companies grow over the long term. And that kind of impacts how we think about our relationship, because the companies are users of Brex above and beyond our capital product. So we're trying very hard to make sure we are providing a broad set of services, capital, software to be able to help drive growth for these companies overall.
Yeah, just to add ours quickly. I mean, I think that the biggest thing that's happened in the world from a capital raising perspective, honestly, in the last decade is the emergence of SaaS. So 75% of companies are running on these cloud accounting systems, cloud payment processors. You can log into online banking. So a lot of the things that banks were built on top of that required paper pushing, like getting an auditor to come in and just double check that the statements match the bank statements match the income statement, are no longer necessary. But those are how a lot of financial institutions are architected. And so what we do, very similar to both other panelists. So, companies come in, if they have a data room already, they just send us the link. If they have only a QuickBooks or NetSuite and Stripe account, they connect those accounts to us. We basically produce all the material that a traditional investor needs to look at in their format. So like we might take a Stripe connection, turn it into cohort analysis, and then put it in an old school presentation and hand it to a bank that would otherwise require you to push paper. And the reason we do that is because while the capital raising process is antiquated for, say, the 5,500 commercial banks in the US, their cost of capital is also 0.25%. So there's just, this trade you make where you're trying to bridge the best of both worlds. Of course, you want the cheapest capital, and of course, you want it to take the smallest amount of time. But practically, that just requires a lot of technology development from guys like us, kind of collectively, to modernize the space.
Right. So effectively, the argument is very much like what the fintechs were talking about even just a few years ago, just broader in the consumer banking space. Effectively, you have more data, you're faster, you have more tech. Yeah, that sounds like that's a huge part of the market. So last question for you guys, because we're running very low on time. Looking forward 5-10 years, do you see the market heading to a place where a larger percentage is going to be debt from now on? Effectively, where do you see this going?
Yeah, well,
I think so.
Go, Ben. Sorry, I'll go last.
No worries. I think so. I think from the point of view of the company, I think companies and CFOs, CEOs, senior management will become more fluent with the different types of capital out there. I think at the end of the day, part of why companies are not accessing less dilutive types of capital is because equity is well known. It's got more straightforward terms, and just there's a less understanding in terms of what's available out there and sort of the downside and the complexities of it. I think companies will get more and more aware of the nuances and become more familiar. And then secondly, as we're talking about, I think there's going to be more data across many different other business models over time, and that data is just going to be able to provide company or capital sources with more comfort as to how to structure a less dilutive deal. Because as Glad mentioned, there's much less upside for the lending type structure. So I think as there's more data availability, there's going to be a plethora of and more comfort of different options available for different types of companies, not only the most highly recurring SaaS software companies.
Totally. And besides that, to build a little bit on top of Ben's point, I think that's what we also see is much more purpose-driven financing, right? So people will not just take a ton of money and put it in the balance sheet to use it, eventually, but financing will be very embedded into specific actions, right? So you have acquisition financing to acquire the companies, or like user growth financing or expense financing, where you're actually getting the financing at the right time, for the right, length at the right price. So that would be also a massive shift, I think.
Well, I am curious. I'll leave this last question to you, Blair, which is, we're talking about how debt is going to be a bigger part of the market. There are already players in it. You guys are disrupting. I am curious, do you ever see a company or a venture capital firm like Sequoia or one of the existing equity focused venture capital firms heading into this space?
Yeah, I can think of 3 off the top of my head who have credit funds. They don't necessarily always publicize them. There's an inherent conflict between debt and equity. So like the short answer is yes. In the buyout space, which is 3 or 4 times larger than the venture space by assets, it's very common for credit funds to coexist alongside equity funds. And there's always rules like the credit fund can't lend to a failing equity company without a third party also making the loan too, because there's kind of taking out of one hand and giving into the other hand types of issues. But those have been solved in the buyout world. And so I think we will see more of this in venture for sure.
Okay, great. Well, thank you everybody for joining us. I'm sorry we can't see the other side of the viewership, but we are very happy to have had you and all of your questions. Thank you again to Benjamin, Blair, and Miguel for being here as well. Really appreciate your time.
Thanks for having us.
Thanks for having us.
Everybody. Thanks.
Have a good one.